So, today, we're diving into a pretty wild prediction from our source material. The idea that 2026 is gearing up to be one of the biggest stock market booms we've ever seen. The argument is that there are very specific government policies being put into place right now to make this happen. So, what are they? And how is this whole thing supposed to work? Let's get into it.
Okay, so this is where it all starts, the central claim that really sets the stage. In late 2025, you have President Trump making this huge statement, promising an economic wave like nothing that's come before. And this right here? This is the big idea we're going to unpack today.
So you have to ask, why is Washington so bullish on this boom? Well, according to the material we're looking at, this wasn't just a one-off comment from one person.
Nope, it was a sentiment that was very quickly backed up by the Treasury Secretary. I love this metaphor that 2025 was just, setting the table for the main course. So you've got the President and the Treasury Secretary singing the same tune. It really makes you wonder, right? What in the world is this prediction actually based on?
Well, the source material we're looking at boils this whole thing down to three main drivers. Think of them as the pillars holding up this entire prediction. We're going to walk through each one.
And here's the roadmap for where we're going. First, lower interest rates. Second, a huge wave of government stimulus. And third, a kind of ultimate backstop for the market. So let's kick things off with that first driver, interest rates.
Okay, so to really get this first part, you've got to understand that there are basically two kinds of interest rates. You have the retail rates, that's what you and I see on our mortgages, our car loans, but underneath all of that, there's the federal funds rate. You can think of it as the wholesale rate that banks charge each other, and that's the one we really need to pay attention to here. So this federal funds rate, right? That's the one the central bank, the Federal Reserve, controls. The source we're looking at highlights that President Trump has been pushing hard to get this rate cut all the way down to 1%. And a lower rate means it's way, way cheaper for big banks and financial institutions to borrow money. And where do you think that cheap money goes? Well, a lot of it could end up flowing straight into the stock market.
So why all the focus on the year 2026? Well, the source points to this one specific date, May 15th, 2026. This date is everything, because that's when the current Fed chair's term is up. The argument is that this opens the door for a new appointee, someone who's on board with the administration's plan, to come in and start cutting that key interest rate, and fast.
All right, on to the second key driver, government stimulus. Now, when the source talks about stimulus, don't just think about those checks people sometimes get in the mail. No, this is a much, much bigger strategy.
The source actually breaks it down into three distinct flavors. Targeted policy changes, a big return to money printing, and just massive deficit spending. Think of it like three different ways to pump fuel into the economic engine, all designed to push the stock market higher.
So first up, let's talk policy. The source points to specific executive orders that are designed to boost American production in really critical sectors. We're talking rare earth minerals, which is a big deal, especially as a response to China limiting its exports, but also AI and the giant data centers you need to power all that new tech. The whole point is to give these specific industries a massive leg up.
But here is where it gets really fascinating. The government isn't just tweaking the rules. It's actually becoming an investor. It's putting taxpayer money where its mouth is. The source highlights that the government has been making direct investments into public companies. We're talking stocks like MP Materials and Intel to directly fuel their growth.
Okay, now for that second form of stimulus, money printing. But to really get this, we actually have to talk about its opposite first, something called quantitative tightening, or QT. It's basically a fancy term for a policy where the Fed was sucking money out of the economy to try and get inflation under control. But according to the source, that all came to a screeching halt on December 1st, 2025.
So what happened the very next day is absolutely crucial. Literally, the day after QT ended, the Fed reportedly printed $13 billion. And then, shortly after that, it committed to printing another $40 billion every single month. I mean, this was a complete 180. They slammed the brakes on one policy and immediately floored the gas pedal on another, flooding the economy with new cash.
And that leads us perfectly into the third type of stimulus, deficit spending. The U.S. government is the biggest spender in the entire economy, bar none. And for 2026, the deficit is projected to be $2 trillion. That is a staggering amount of money being spent into the economy that the government doesn't actually have from taxes, and all that spending directly fuels corporate activity. So, this brings us to our final and maybe the most important driver of this whole prediction. We're talking about the underlying mechanism that makes all this possible, the system's ultimate safety net.
So you have to ask,
how can the government possibly spend trillions more than it brings in? Well, the source explains that the Federal Reserve essentially acts as the government's lender of last resort. It's pretty simple. When the government needs cash to fund all its spending and can't find enough buyers for its debt, the Fed can just step in and, well, print the money to cover it.
And when you put all of this together, the low rates, the massive stimulus, the Fed's backstop, you arrive at the core argument from our source material, that our entire economic system, as it's set up right now, is basically designed to do one thing above all else: support asset prices, and in turn, make the investor rich.
So, after all that, what's the big takeaway? The source suggests a really straightforward strategy. Just follow the money. The idea is, if you want to understand where the opportunities might be, you just have to pay close attention to which industries are getting a boost from new government policies and direct investment.
And that leaves us with one final, pretty provocative thought. We've just walked through this entire argument that the system is, by its very design, built to favor the investor. So, if that's true, it really makes you stop and think. What does that mean for everybody else?